Here's the reality. A single family rental can produce income. An Airbnb can produce spikes. A flip can produce a payday. But multifamily produces systems, and systems outperform effort every single time. In this video, I'm gonna break down why multifamily real estate, when structured correctly, significantly outperforms. Single family rentals, short-term rentals like Airbnbs and VRBOs, BRRRR strategies, RV parks, self-storage, and other small commercial assets. Not in theory, I'm gonna actually get into the numbers in this video. We're gonna look at cash flow per dollar invested, risk concentration, the vacancy math, expense ratios, financing leverage, scalability, and long-term wealth creation. And by the end of this video, you're gonna understand why serious capital allocators always graduate to multifamily, and why many investors eventually abandon everything else. Let's break it down. If we haven't met yet, I'm Adam Williams, founder of Elevest Capital. I've spent over 20 years investing exclusively in multifamily real estate. Last year alone, we completed over $200 million in transactions, and I added more than 1,300 units to our portfolio. I've evaluated almost every single real estate strategy you can imagine, and I didn't choose multifamily by accident. I chose it because mathematically and structurally, it wins hands down every single time. You see, most investors don't choose strategies based on structure. They choose it based on accessibility, YouTube popularity, perceived simplicity, or early success stories. But once you scale beyond a few $100,000, the math changes. First off, let's look at the core problem with most small scale strategies. They're linear. You buy one property, you manage one property, you finance one property, you repair one property, and you put a tenant in one property. Now, to double your income, you have to double your workload. But multifamily is different. It's geometric, and that changes everything. Let's look at comparison number one. A single family rental versus a 50-unit multifamily property. Let's assume the single family rental purchase price was $400,000. You put $200,000 down, that's $80,000 in equity. Your rent is $2,800 a month. Your annual gross rent is $33,600. You have a 35% expense ratio, which includes taxes, insurance, repairs, vacancy, and property management. So you have a net operating income of $21,840. Now, subtract the debt service. Let's just assume 6.5% on your loan. That's an approximate annual cash flow of $4,000 to $6,000 per year. That's around a 5 to 7% cash on cash return. Now, compare that to a stabilized 50-unit multifamily asset. You have a purchase price of $10 million, 65% loan to value, so you're gonna require about $3.5 million in equity on that deal. The average rent is $1,400 per unit. That creates a gross income of $840,000 a year. With a 45% expense ratio, that gives you an NOI of around $462,000. And after debt service, your annual cash flow is about $210,000. That's a 6% cash on cash return. Similar on the surface, but here's where it changes. If you increase rent by just $100 per unit per month, that's 50 units times $100 times 12 months. That's $60,000 of additional NOI every single year. And at a 5.5 cap rate, that increases the property value by $1.09 million. You cannot force that level of appreciation in any single family rental. And multifamily is value driven by income, while single family is driven by comparable sales. You're always relying on what your neighbor sold his house for. The difference alone is enormous. Now let's talk about vacancy risk. In a single family, if your one tenant leaves, your vacancy is at 100% and your income goes to zero instantly. And you're still responsible for all of the debt service, your taxes, your insurance, your utilities, and on and on. But in multifamily, if one tenant leaves in a 50-unit building, your vacancy is only 2%. Your income barely moves and you still have positive cash flow every single month. This is called risk dispersion. Vacancy in multifamily is statistical. Vacancy in single family is catastrophic. Now let's talk about expense ratios. Small rentals typically operate around 35 to 45% expense ratios, but that excludes your owner time. Now let's talk about the benefits of multifamily. You have on-site staff, you have bulk vendor pricing, you have scaled maintenance, professional management, and insurance economies. And as your unit count increases, your cost per unit drop. You don't get cheaper per roof with a single family home. You get leverage with multifamily. Now let's do the second comparison, an Airbnb versus a multifamily property. Let's say you have a $500,000 purchase of a nice Airbnb. You put $100,000 down. Your average gross is around $80,000 annually. That's kind of optimistic, but we'll just go with $80,000 a year. All right, you have a 50% expense ratio because you have cleaning, platform fees, management, utilities, furnishings, and then you have some seasonality built in there. So you're netting about $40,000 a year. Your after debt service cash flow may be around $10,000 to $15,000, but the volatility is super high. In addition, you're going to have regulatory risks, you're going to have seasonality like we talked about, you're going to have platform dependency, and you're going to have economic sensitivity. In multifamily properties, you have a historic occupancy of around 92 to 95% nationally. People may stop traveling, but people rarely stop needing housing. You see, multifamily demand is fundamental. Short-term rental demand is discretionary. When the economy tightens up, people aren't going to sit out their basic housing and leave their apartment, but they are going to stop going on vacation to your Airbnb. All right, let's get into the third comparison, the BRRRR strategy. I've got a lot of friends that do BRRRRs. They do very well, but here's how it stacks up against multifamily. BRRRR works, but it's operationally intense. You buy, you renovate, you refinance, you rent, and you repeat. That's what BRRRR stands for. You see, each deal requires contractor oversight, individual financing, appraisal dependency, and market timing. To scale to 50 units, you got to go through this process 50 times. But in multifamily, you do one transaction, your scale is immediate. The time compression alone is massive. All right, let's get into comparison number 4, self-storage. I love this one, and self-storage was the buzz for many, many, many years. I have friends that own self-storage, and self-storage has strong margins. Your typical expense ratio is only 30 to 40%. But storage is hyper supply sensitive. It's often located in tertiary markets. It's extremely competitive, and it's less recession resistant than housing. In downturns, businesses shrink, people consolidate, and storage demand softens. But multifamily demand persists because housing is not optional, but storage is. All right, comparison number 5, RV parks. You see, RV parks can produce high yields, but financing is limited, your tenant base is typically transient, your infrastructure risk is high, your weather risk is real, and cap rate compression is inconsistent. These are niche plays, but multifamily acts as an institutional play. You see, institutional capital drives pricing stability, and that matters long term. All right, now let's get into the structural advantages of multifamily. I want to zoom out for a minute and look at why does multifamily outperform? Number 1, it's income driven. You control value by increasing your net operating income. You raise rents, you reduce expenses, you improve operations, and you create equity. See, other asset classes rely on market comps, but multifamily relies on execution. Number 2, it's scalable. You can scale from 10 units to 1,000 units using the same management team, using the same underwriting frameworks, using the same vendor network, and using the same financing relationships. See, single family scaling, it becomes a management nightmare. All right, let's talk about the financing. Multifamily loans are based on asset performance, where single family loans are based on your personal income. And that difference becomes enormous as you scale. You can qualify for maybe 10 homes, but you can qualify for thousands of multifamily units as long as the deals qualify. All right, number 4, it's resilient. Historically, housing occupancy remains stable even in recessions. Rent growth slows but rarely collapses. And multifamily rebounds faster than retail or office because people will always need a place to live. All right, number 5, it produces predictable wealth. Let's look at the long-term math. If you invest $100,000 in a 16% IRR multifamily deal over 5 years with an equity multiple of 2x, you'll have an ending value of your capital of $200,000. Do that 3 cycles over 15 years and you take $100,000 goes to $200,000, $200,000 goes to $400,000, and $400,000 goes to $800,000. That's compounding in structured income producing assets. It's not gambling on appreciation. It's executing a business plan. And the best thing is that with multifamily, even if you don't want to do any of the work, you can invest as a limited partner and have someone else do it all for you. And you can still realize the same returns we just discussed. I know this because this is our exact model at Elevest Capital, and we've done it successfully dozens of times over thousands of units. This isn't about saying other strategies don't work. They do. It's about understanding the ceiling. You see, single family is a job. Airbnb is a job. BRRRR is a job. But multifamily is a system. And at scale, systems outperform everything else. Let's get into the passive framework application. First off is predictability. You get a diversified tenant base. Next is alignment. You get institutional debt and underwriting. Next is safety margin. You get vacancy dispersion and NOI control. All right, next is scalability. You get 50 to 500 units in one transaction. And next comes inflation resilience. You get annual rent adjustments that naturally increase over time. Then comes volatility exposure. You get housing demand stability. And finally is exit clarity. You get income-based valuation. And that's why serious allocators gravitate towards multifamily. For over 2 decades, multifamily has been the engine I've used to build real wealth. Not because it's flashy, but because it's structured, because it scales, because it's resilient, and because the math compounds. And in my experience, multifamily isn't just another real estate strategy. It's the professional version of investing in real estate. You see, there are 2 types of investors: those who collect properties and those who build portfolios. See, one chases deals and the other builds systems. I have investors reach out to me every single week who have collected a bunch of single family rentals and they're tired of the grind. The conversations are always the same. Can you please help me get out of these rentals and into multifamily? I'm tired of the responsibility and I want to be fully passive. And my answer is always absolutely. Welcome to freedom. If you want to explore how multifamily can fit into your portfolio or how it compares with what you're currently doing, visit elevestcapital.com and book a call. We'll evaluate your capital position, your income targets, your current strategy, and whether multifamily aligns with your long-term goals. And in the next video, I'm going to break down exactly how we structure deals to target a 16% IRR and where most sponsors go wrong trying to hit that number. I'll see you there.